All right, folks, we have quite an interesting story about Amazon, or Jeff Bezos for that matter, potentially being behind this whole naked shorting thing into AMC because potentially remember back in February in the middle of the COVID crisis in pandemic, there were multiple articles flying around the internet by reputable sources implying and suggesting that Amazon might be eyeing to buy out AMC. All right, and it kind of makes sense because Amazon it's mainly online through the streaming services platform, right? And it kind of makes sense for them to have a physical store company to actually stream physically their movies because they actually provide their own movies. Well, we have now uncovered multiple of kind of connecting some dots, and actually it's quite an interesting story. So let me just walk you through what is actually happening here. So first of all, before Amazon actually started and was created by Jeff Bezos, he used to work for a trading company, an investment firm named D.E. Shaw. So D.E. Shaw is a company that also started as a bookstore. You will see here when we go on their website and who we are. So founded in 1988 over a small bookstore in downtown New York, the D.E. Shaw Group began with 6 employees and 28 million in capital and quickly became a pioneer in computational finance. What do we do? D.E. Shaw Group is trusted by investors across the world and they seek optimal balance of risk and reward. We know and they're renowned as a pioneer in quantitative investing, quant strategist. So when Jeff Bezos joined this team, he was working within the quant team, and he was the youngest vice president in this company, D.E. Shaw. Why? Because he was smart, and lots of strategies that the quant portfolio use has to do with naked shorting and creating synthetic shares. Now, it gets interesting when Bezos actually had the idea of being one of the biggest retail company in the world, but instead of going anywhere, he started just with books. Remember, this company also started as a small bookstore in downtown New York. So when Jeff Bezos had the idea, he goes to see D.E. Shaw, all right? And then D.E. Shaw actually knowing the online booking or the booking business sees the potential not only by selling books online, but seeing beyond actually what the very first idea is, and in 20 years from now will be what we know as Amazon. So they started actually doing as they grow what we call a bust out scheme. Well, I'm not an expert on the subject, but from what I heard or read quickly, a bust out scheme is pretty much a strategy that you use in order to get rid of all the competitors. So Amazon or Jeff Bezos creating Amazon and working hand in hand with D.E. Shaw, for which he has a very good relationship, were actually doing or shorting heavily stocks of other companies in any space that they wanted to be the leader. They wanted to be the king. They wanted to be the very top company without any competitor. And that's why, if you really think about it, right now, if you want to buy any toys, you go to Amazon. Toys R Us used to be the biggest, and now they are nowhere. They got bankrupt, okay? Now you talk about the movie theater, Blockbuster. Blockbuster used to be the main guy, and then Amazon, actually the biggest money coming from Amazon is not from people selling and wholesaling. It's not a dropshipping thing. It's the whole Amazon Web Services, the cloud computing thing. This is where the real money of Amazon is coming from. And it seems like they use this same strategy to also get out of business Blockbuster company. Same thing with Sears, which is also another big retailer that is, really big in appliances. Now, the thing is, there might be also a link between D.E. Shaw, Jeff Bezos, and Citadel, because in order to heavily short those companies, those stocks, you need to have someone that has the ability to create synthetic shares. Citadel is the perfect link, and even before Citadel kind of grew to begin to become what they're actually now, back in 2001, these three were kind of linked by Jeff Bezos. All right, and that's how. When you actually look at how the whole movie industry is now, AMC is the biggest leader. AMC is the leader. And the fact that Amazon wanted to get into the movie space, it wouldn't be surprising that he will use the same technique he also used to make sure Toys R Us, Sears, or Blockbuster were out. But the thing is, he got into a company that was bought out by millions of retailers. But what they do is actually, this strategy will help them, will pretty much give them the opportunity or the ability to, by shorting the stock of the company, okay, they make a lot of money on the way down. But when the company it's now broken down, they buy it back for a penny on the dollar, for pretty much pennies, and they don't have to pay taxes on that. That's why these guys actually saying this has to change. Yes, I think that's how this scam works. They borrow, say, Blockbuster stock, sell it short, sell it to short it, and as long as they maintain the short position indefinitely, they never close, and from a tax standpoint, they realize a profit. So if the company is bankrupt and the share value drops to zero, it costs them nothing to maintain the opening short positions and never pay tax on the original short sale. That's why he thinks the tax code needs to be updated to close the loophole and force profits to be booked once a company is bankrupt or delisted or share price goes to zero. So just now imagine the number of zombie companies shares on Wall Street firms' books, and they have never and will never pay tax on the profits from those trades. I mean, looking at what Blockbuster is actually trading on. It's actually trading around 10 cents, guys. I mean, 18 cents. 18 cents. But today, it went all the way up and gained 1,700% today. But back in January, when GameStop also was in the middle of a short squeeze, this stock also short squeezed. This stock also closed back in January, exactly at the same period with GameStop. Why? Because the same Citadel, the same guys that are shorting GameStop, shorting AMC, were also having this on their books. It will make sense that, hey, these guys allegedly will have been the one to create all those bust out scheme in order to make sure these companies that Amazon was kind of targeting to make sure they're not on the radar anymore in order to be the number one competitor. The only competitor, the only company on the retail space. Now, what is even more interesting is when you look at the portfolio, the book of Citadel and D.E. Shaw, you actually realize that, hey, Amazon is the number one, the top and the biggest holding of D.E. Shaw. They used to be invested over $2 billion on Amazon. But when Jeff Bezos, stepped down as CEO, they reduced it to 1.3. Now, Citadel is even further. Citadel is holding more than $13 billion worth of Amazon. So whenever they are shorting these guys and the money that they use not to pay taxes because they're making money while the short price, goes to zero, since there's no taxes to be paid on that, they will keep those on the book just to make sure they never close the positions, okay? And use that money to put back into Amazon. Why? Because if Amazon has no competition, if Amazon is the biggest and the only king in the retail space, the share price will keep climbing. Back in 2001, the share was around $48. Now it's what? Almost more than $3,200. That's even more than a 10,000% gain. So I guess it kind of makes sense at a point that, hey, maybe this whole time we've been aiming at Citadel, but the central actor in this whole thing might be Jeff Bezos. Why? Because he wanted to acquire AMC, because it does make sense from a business standpoint. Let me finish by saying this, guys. I'm not saying exactly that this is 100% true, but it kind of makes sense when you connect the dots. By looking at the books, by looking at what they did to other companies, by looking at what is actually happening, by looking how it will make sense from a business standpoint. But at this point, this might never have a solid proof in court or something else, but it kind of just makes sense. Now the thing is, it costs money to sustain and maintain short positions. With these companies, the actual stock went to zero, the company filed bankruptcy, but with AMC, things went the total opposite way. That's why they are still bleeding and using a ton of money every single week, because if they started shorting this at $2, man, at 44, they are down huge. That's why the potential of this going to unimaginable highs, it's even more serious at this point. I mean, I'm just saying, 2 cents.